From shifting public policy to concerns about market bubbles, there's a lot shaping the 2026 outlook for business owners right now. Plus, with midterm elections just a few months away, what should be top of mind for investors? We're going to break that all down for you and a lot more right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. In the studio with me as my guest from the Chief Investment Office is Paul Shao. Paul, great to have you back. Good to see you.
Happy New Year. Happy to be back.
Happy New Year. I know we haven't really done any of these studio sessions since last year, which brings me right to where we are today. We're about a month into the year. Markets, data releases, some of them have been surprising. We've seen inflation come down a little bit since November and December. Markets right now, if you look at the S&P 500 index, it's flat for the year, but with surprises on either side. We're still in the middle of earnings, so there's a lot to digest there. What are the drivers? You call it the run it hot, quote unquote, narrative. What are the drivers behind that particular theme?
Right. So if we look at what growth expectations for 2026 have been over the last year, rewind back the clock about a year ago, a lot of forecasters thinking, 2026, another year where growth will be about trend, about 2%. That has been taken down a lot after Liberation Day when you had that swath of tariffs, and now it's gradually picking that up. But towards the end of 2025, even with the government shutdown, something that we've been seeing is that growth surprises have been to the upside. And that's really fed into GDP growth, and we're now expecting growth to be pretty significantly above trend for this year. And I think that has pretty profound consequences for a lot of asset classes. You mentioned that the S&P was about flat, but if you look at different asset classes that have been performed this year, cyclicals versus defensive, commodities, it's all emblematic to us of an economy still in reflation mode. And if you take a look at a chart that we prepared, going at the last, if we break in quadrants of inflation and growth, you can see that we've been in the top right-hand corner, which is reflation, for quite some time, and we'll probably be there for the first half of 2026 because we'll have some of the stimulative effects from OBBA, maximizing the cash or minimizing the tax burden for a lot of households and businesses that are primed to spend. But also through that, a lot of the anxiety and apprehension about what does the second term of a Trump administration look like. That's a bit different this year since investors are much more used to it. And if we take a look about where risk assets are compared to measures of geopolitical risk, we can see that markets are not as responsive to, let's say, tariff developments or geopolitical responses because they want to see what the White House actually does instead of what it says going to this year. And that has actually increased confidence and positioning going to 2026, which underpins our position about running it hot. So it's in a benign macroeconomic background. There's still a bias for the Fed to cut rates and ease policy this year, and markets are responding accordingly.
What about this kind of look, this is not a new question. I'm sure you've heard this before. We've talked about it in the studio with you and other guests. There's concern about bubbles. I think people think about bubbles. They think about the 2008 and 9 great financial crisis and what led to that. They think about the tech bubble in the late 90s, early 2000s. You can even go all the way back to the 1920s and multiple decades afterward. There's been bubble after bubble when it comes to the markets. And AI has brought up the question: Are we in a bubble? Are we in a bubble? So the question I bring to you is the bubble talk legitimate? I mean, as CIO, are we thinking that this is potentially bubble territory, or is it something else?
Right. I think with the price action that has happened a lot with the Mag 7, optimism about new technology, something like this, it's not something that's new. Ever since the tulip craze or the Dutch East India expansion a couple hundred years ago, there's always been talks about mania and all worries about that. And most recently, especially with AI, some investors are thinking, is this a repeat of the 2001 tech bubble, and are we going to see the similar response? If we take a look at this chart, and this is just rebased to, the gray line shows a NASDAQ performance rebased to the launch of Netscape, which was in 1994, which feels very
like long. A million years ago?
It feels a long time ago. But if we track that compared to where ChatGPT has been launched in 2022 and NASDAQ performance, we can actually see that it's actually very, very modest compared to the tech bubble and that we saw in the 2000s. And if this chart is any precursor, we still have not only a lot of room to run in terms of price appreciation, but in terms of length, we do see that if we just follow this chart as an indicator, we have another 2 or 3 years to run before bubble speculation becomes more rampant. But taking a deeper look, which is what CIO has done, the primary difference between now and other bubbles is that there's actual real revenues that underpin the price movements for the Mag 7. That also, with the Q4 earnings reports, really strengthens our confidence in that. That all said, we do think that in this environment, just given how concentrated stock price performance has been over the last 2 years, we're seeing that with economic conditions still pretty robust, policy making is still biased towards easing, we're expecting much more broadening out, not from the tech sector to sectors that have had less appreciation, like consumer discretionary, like healthcare, and like utilities, because we think valuations are a little more attractive in these sectors. But also, we think that the next part of the AI trade is moving from infrastructure, data centers, LLM models, to which companies can actually use this technology to maximize their margins. And we do think that consumer discretionary, utilities, and healthcare, they're examples of adopters that have seen some gains so far, and we think will accelerate in 2026.
That's part of the great broadening theme that CIO we're talking about, which is broadening your investment opportunity and horizons by looking at other sectors like consumer discretionary, for example, that may have some room to grow this year, given the one big beautiful bill from last year. Obviously, given where expectations are for the economy and for what the Fed may or may not do, which actually brings up a really good point. Kevin Warsh, at this point, as we're sitting here, has been nominated by the president, so we'll have to see what happens if he gets confirmed. But given what we know of him and his past voting records and the way he thinks about monetary policy, dovish, hawkish, from a policy perspective, how should business owners be concerned, or how should they be thinking about if Kevin Warsh does become the replacement for Jerome Powell?
Yeah, I think you hit the nail on the head. There was a very big question for business owners, markets, and investors. Who's the next head going to be? Because I think the big question was, will the Fed be independent under this kind of White House, which has shown to show a lot more influence in terms of monetary policy decisions than previous White House? And I think for many in the market right now, they're breathing a sigh of relief with the nomination of Warsh. He's been a past member of the Fed. He was there during a past crisis like 2008. And given where the White House wants, lower interest rates across the board, you have a rather outspoken member who has been against programs such as quantitative easing in the past. So it's not clear that he'll be an ultra dove versus other members, which actually strengthens the credibility of the Fed. And we take a look at the chart that we have on the screen too. Treasury market volatility is actually the lowest point in years, which should be quite a good signal for overall markets and how his nomination is being taken by the broader market. We think that just given where his comments are and what the macro conditions we think are going to happen over 2026 will be largely continuation of policies set by Jerome Powell. We had an expectation of rate cuts happening in 2026 with the nomination of Warsh. We think that will continue to happen probably in the back half of the year, where you have growth starting to moderate back towards trends, and that inflationary pressure that we're expecting at the top half of the year also continue to cool, which will set the door open for the Fed to cut rates.
Great. And we only have about a minute left, Paul, but I wanted to ask you, because we do have a midterm election coming up, and I mean, it's months away, but the way things go, especially with news cycles, it feels like it happens a lot more quickly than it ever did. So should business owners and investors in general, what should they be thinking about? Is it too soon to even get ahead of what the potential results in the midterm elections could be? It seems far away, but is there any way to prepare for that?
I think the pattern of midterms being good for the oppositional party seem to maintain in this election cycle. But what we're telling to clients and what we're telling to business owners, that the way to think about midterm elections is a reminder that the volatility that we are seeing from the White House will most likely be constrained in 2026. Part of it is there's a political reality that the White House has to deal with, where affordability is still the top concern of many households across the United States. Many of them don't agree with tariff policy, so we think that'll be a constraint on unpopular programs such as tariff policy, for example. There's a financial reality that the White House also has to deal with where investors are are looking deeper into what bond yields are doing relative to the debt. We saw the spike up in longer end Japanese yields based on what the Prime Minister wants to expand their budget is doing. And we saw yields elevated in the US too, with debt to GDP ratios around 120% already to GDP, especially with the passage of OBBBA. We think that this will be another constraint about what the White House can do. And then the last thing is really just the economic reality that the White House is facing right now in terms of their policy decisions. We're still in a place where they do want to see lower interest rates, and it's hard to do that where inflationary pressures are building with programs such as more tariffs coming on board, but also growth has been doing quite well, which is underpinning the stock market. So as long as the stock market is going up, it's hard to see that the White House really wants to rock the boat or upset the current trend. And the chart that we had on screen just now is just showing what we're saying, which is a volatility as well as geopolitical index, and where the headlines are saying that geopolitical risk is a little high, markets aren't reacting as much because they want to see what the White House actually does versus what it says, which I think adds to our overall constructive view about risk assets into this year.
Great. Paul, thank you very much. I know it's always a lot to get to when we sit down, but I appreciate you taking us through. We'll get you back in a couple of weeks and we'll talk again and see where we are.
No, my pleasure. Thanks,
Great.
Anthony.
Thanks, Paul Shao from the Chief Investment Office. Thank you all again for joining us. There's a lot more information coming out of the Chief Investment Office at our Insights website. The web address is ubs.com/views. Plus, you can take a look at social media. We're on the major apps, LinkedIn, Facebook, etc., plus Instagram. You can check out our dedicated channel there at UBS Trending. Lots of great studios content there for you to find. As always, we always encourage you, if you'd like to continue this conversation, please do so with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.